Okay, let's take a look now at overseas markets and how we set up for the week here. Ashraf Laidi, who is Chief Global Strategist at City Index in London, joins us now. Ashraf, nice to see you again. Go through some of perhaps the Chinese data and also the moves out of Japan that help set the pace for the global markets today.
Right. If the Chinese data and the Bank of Japan data have something in common, is that the central bank of both nations are doing all they want to relieve to maintain the liquidity. Bank of China is draining, basically draining some of the reserves that it had before. But the Bank of Japan, this is interesting. It's really in line with keeping renewed weakness on the yen. Basically, we had the prior day, we had a disappointing Q4 GDP numbers from Japan, and that weighed on the yen. And then we had this news here about doubling the loans to commercial banks, which increases liquidity, puts a negative impact on the yen. And as we have known, that a weaker yen goes in line with improved global liquidity and improved risk appetite. And that's why the word emerging market has disappeared from the news, being a positive impact. And we're seeing equities pushing higher. Though there might be some question marks coming up in the next 24 hours when we get the minutes from the last meeting from the Federal Reserve that will tell us an idea to what extent is the Federal Reserve putting its foot on the brake pedal.
What will you be looking for in particular in those minutes when we get them?
To what extent basically the Federal Reserve remains on autopilot, regardless of what happens with emerging markets. I think that right now the path of least resistance is for the Federal Reserve to do for another 10 billion tapering next month. Bond yields are low. There is no tightening in the bond market. Emerging market concerns have eroded. Maybe what we look for the minutes is the extent of the disagreement, to which they want to continue with the tapering. But I don't think there's gonna be any dissent.
To the European picture now, inflation down a bit, disinflation, if you will. Confidence in Germany down a little bit, but it was at a 7-year high, I think. So I wonder if you can just put that into context for us. Or is that something to worry about or not really?
If we break down the ZEW survey, the business sentiment survey, the investor sentiment survey from Germany, the expectations index actually came in weaker than expected. It fell. But the business indicator, it actually went to a 3.5-year high. So that's a positive thing. And this is helping the euro hitting, going above 137. The inflation numbers that you were referring to, alluding to, were in the UK, where inflation has fallen below the 2% target of the BOE for the first time in 2009. But here is the interesting thing. The UK is the only country where lower inflation is preventing the pound or the currency from falling. Why? Because falling inflation is coming in at the same time with falling unemployment rate, and that's why, and that's why really it does not mean that weaker inflation in the UK meaning weaker growth. And the positive thing is that real pay, that is earnings minus inflation, is continuing to get back to zero, which is a good thing for the pound and for the UK economy.
We've seen gold rally so far in 2014. How much momentum do you think is built up into the gold price?
We still think that this is a corrective phase and not a new impulsive move, to say. And so this is still a corrective phase of a downward trend here. We're not seeing any risks to inflation to the upside. We think probably really the key resistance would be around 1370, even though we've broken above the 100-day moving average. We think 1370 would probably be the next big target and also a ceiling.
And I wonder, just to go through a couple of sets of earnings, just how they set the stage in Europe. I'm noticing Inditex, which is the owner of Zara clothing, for instance, the retail picture globally and in Europe is down about 3%. There's been a downgrade for Zara. How does the retail picture look, I guess, Europe and more broadly for this particular company? It's typically done very well.
Yeah, so while we usually stay away from talking about individual the companies here, we will talk about, the retail sector. Basically, you've got a very strong purchasing power in Northern Europe, especially, in Germany and actually in some parts of Italy as well as the UK. From the retail numbers that we are seeing, with the European consumer is continuing is actually starting to have the role of what the US consumer was, which is basically carrying the economy on its back. It might be a good role for the retailers because of the discounting process, which is actually not helping the retailer themselves. But on the positive, you're seeing that there is a recovering demand from the consumer, which is a sort of a net balance for these retailers.
Okay, great to get your thoughts, Ashraf. Thank you for joining us this morning.
Thank you.
Ashraf Laidi is Chief Global Strategist at City Index, and he joined us from London.